Ever wondered why a strong credit score holds so much importance in our lives? It's like the silent protagonist in our financial story, working behind the scenes, influencing our financial decisions and opportunities. You see, a strong credit score is more than just a number. It's a reflection of your financial reliability, a testament to your monetary discipline and planning, kind of like a financial report card that follows you throughout your life. It's a key that can unlock doors to various financial opportunities. Your credit score plays a crucial role in the kind of loans you can secure and the terms of those loans. A strong credit score can mean the difference between being approved or declined for that mortgage you need for your dream home. It can influence whether you get that car loan for the shiny new wheels you've set your eyes on. And it's not just about securing loans. A robust credit score can help you negotiate lower interest rates, saving you a significant amount of money over time. It's like a VIP pass, granting you access to better financial deals and opportunities. But the influence of a strong credit score extends beyond just financial transactions. It can also impact your job applications. Some employers check credit scores to gauge an applicant's responsibility and reliability. A strong score can help make a positive impression, giving you an edge in today's competitive job market. Your credit score is also a factor when renting a home, getting insurance, or even setting up utilities. It can impact almost every aspect of your financial life. So, you see, establishing and maintaining a strong credit score isn't just about getting approved for loans or credit cards. It's about creating a strong financial foundation that can provide stability, flexibility, and more choices throughout your life. Understanding the process of building a strong credit score is a crucial life skill. And that's exactly what we are going to explore today. So, what forms the foundation of a good credit score? Let's dive right into it. First and foremost, your payment history plays a pivotal role. It's essential to pay your bills on time, every time, as missed or late payments can have a detrimental effect on your credit score. Think of it this way. If you're consistently punctual with your payments, it signals to lenders that you're reliable and can manage your debts responsibly. Next up, we have credit utilization. This refers to the percentage of your available credit that you're using. For instance, if you have a credit card with a $5,000 limit and you've used $2,000, your credit utilization is 40%. It's recommended to keep this number under 30% to maintain a healthy credit score. Thirdly, the age of your credit history matters. Lenders like to see a long history of good credit management. This doesn't mean you're out of luck if you're new to credit, but it does mean you'll need to be patient. Building a long credit history takes time, but it's well worth the wait. The fourth factor is the mix of credit accounts you have. This includes credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans. A diverse mix can be beneficial as it shows lenders you can handle different types of credit. Last but not least, are credit inquiries. These occur when a lender checks your credit for a loan or credit card application. While one or two inquiries won't hurt too much, several within a short period can lower your score. It's important to only apply for new credit when it's truly necessary. By understanding these factors, you are already ahead in the game of building a strong credit score. Now, let's dive into some effective strategies for building a strong credit score. First off, if you're just starting out or need to rebuild your credit, consider getting a secured credit card. This type of card requires a cash deposit that serves as your credit line. It's a great way to prove to lenders that you can manage credit responsibly, without the risk of getting in over your head. Another strategy is becoming an authorized user on someone else's card. This means you can benefit from their good credit habits. But remember, their bad habits can affect you negatively as well. So choose wisely and make sure it's someone who manages their credit well. If credit cards aren't your thing, you can also look into credit builder loans. These are small loans held in a CD or savings account while you make payments. Once the loan is paid off, you get the money back, minus any interest. It's a solid way to build credit and save at the same time. Now let's talk about credit habits. Making your payments on time is crucial. Late or missed payments can have a significant negative impact on your credit score. So set up automatic payments or reminders to ensure you never miss a due date. Keeping your credit utilization low is equally important. This means not maxing out your credit cards and trying to keep your balance at 30% or less of your available credit. High utilization can indicate to lenders that you're reliant on borrowed money, which can hurt your credit score. And finally, don't forget to diversify your credit. Having a mix of credit types such as credit cards, student loans, or a mortgage can show lenders that you're capable of managing different types of credit. Remember, the key to building a strong credit score lies in consistency and discipline. So stick to these strategies and watch your credit score rise. You've started the journey, but how do you keep track and continue improving your credit score? Good question. The answer is regular monitoring of your credit scores and reports. This is a fundamental step in maintaining and boosting your credit score over time. Why is monitoring so crucial, you ask? Well, it's like keeping an eye on your financial health. Just as you would want to know if your physical health is in good shape, you'd also want to keep tabs on your credit health. It's about knowing where you stand and what areas you need to work on. Let's delve a bit deeper into this. Your credit report is a record of your credit history. It's a bit like a report card for your finances. It contains information about your credit accounts, your payment history, and how much of your available credit you're using. Now here's the thing. Errors can creep into your credit report. These could be as simple as a wrong address or as serious as a fraudulent account opened in your name. And these errors, if uncorrected, can drag your credit score down. So how do you spot these errors? By regularly checking your credit report. If you find an error, reach out to the credit bureau that produced the report and the lender that provided the information. Write a dispute letter explaining the error and provide any supporting documentation. The Bureau is required by law to investigate and correct any mistakes. But keeping track of all this information can be a daunting task. That's where credit monitoring services come into play. These services keep an eye on your credit reports and alert you to significant changes. This could be a new account being opened, a late payment, or a drastic change in your credit score. Credit monitoring services can be a valuable tool in your credit building journey. They can provide you with timely alerts, allowing you to address potential issues promptly. However, remember that these services are just tools. The real work of improving your credit score lies in your hands. Practicing good credit habits, making payments on time, and keeping credit utilization low. Regular monitoring not only helps you track your progress, but also alerts you to any potential issues that could harm your credit score. So, roll up your sleeves and take control of your credit health today. Now, let's quickly recap what we've learned today. We started out discussing the importance of a strong credit score. It's not just a number, y'all. It's a reflection of your financial responsibility. It can open doors to better interest rates on loans, easier approval for rentals, and even influence job opportunities. It's a key player in your financial journey, and that's why it's essential to keep it healthy and robust. We then delved into the foundation of a good credit score. Remember, it's a mix of several elements. Your payment history and the amount of debt you owe are the heavy hitters, contributing to a substantial portion of your score. The length of your credit history, the types of credit you have, and recent credit activity also play significant roles. It's like a financial pie. All these pieces coming together to create the whole picture. Next, we explored strategies to build a strong credit score. We talked about starting with a secured or co-signed credit card, becoming an authorized user on someone else's card, or using credit builder loans. We also touched on the potential benefit of using rent, phone, and utility payments to build credit. Remember, it's all about showing you can handle debt responsibly. Then we emphasized the importance of monitoring your credit score. Keep an eye on it, folks. Regular check-ins can help you catch errors, see your progress, and understand how your financial behavior affects your score. It's like a financial health checkup, letting you know where you stand and what you need to work on. With these steps in mind, you are now equipped to build a strong credit score. Remember, a good credit score is not built overnight, but with consistency and discipline, you can achieve it. Don't forget to like this video, subscribe, and turn on notifications for more insightful content. Until next time, keep striving to improve your financial health.